Mm. I am the hunter. I am the great unknown. Only my love can conquer. I am the hunter. I am the hunter. Into the wild we go. Give up your heart, surrender. 'Cause I am the hunter. We've been on this road to a place that one day we'll know. Adventure to the other side. Searching high and low for the treasure deep in your soul. The fortune teller's always right. Got them red eyes in the night, like a panther out of sight. Gonna sing my battle cry, 'cause I am the hunter. I am the great unknown. Only my love can conquer. I am the hunter.
Hey, it's Soleil, and this is episode 433 of the Orange Pill Investor. And today I want to talk about something that was inspired by Matthew Krider's video that came out today. And he's been covering some cautionary tales on strategy and Bitcoin treasury companies in general. He's a Bitcoin maxi. He doesn't have any investments in Bitcoin treasury companies, which is totally fine. And he's generally has a favorable opinion of strategy and Michael Saylor running the playbook. But he's one of the only bearish voices or people that are highlighting some of the dangers that people need to be aware of. Like, he's got some legit takes. And so I think it makes sense to pay attention to the people who have a good track record of actually making sense, like real Bitcoiners, not just like people creating FUD for no reason. And occasionally Saylor will even, retweet some of Matthew's stuff. And basically what he was talking about in his video today is that these hedge funds, and everybody's been talking about Jim Chanos lately, but these hedge funds are basically vultures. I call them hyenas in the title. And they are going to smell blood in the water when Bitcoin takes a dump, as it always does. I know people are talking about the super cycle and maybe there's no bear market this time and it's just up, number go up, technology forever. But not only do I happen to think that human psychology will continue to do what it always does in like FOMO into Bitcoin when it's running, which will cause some people to get wrecked with leverage, and then the system has to settle that up, right? Especially with Bitcoin, like there's no way to hide, or there's nowhere to hide with Bitcoin. Previously, you could be a company that was too big to fail, or you could try to game the system in the S&P 500 by gaming your market cap, and you can borrow a bunch of money to buy back your shares, and you can play those games. But with Bitcoin, there's nowhere to hide, right? You go up leveraged and you get liquidated, and then that's just how it is. Somebody else now owns your Bitcoin. And strategy has already proven that it can weather a bear market. So it's got that under its belt. And it has more tools at its disposal. So when in nature, when the predators go out hunting, they kind of stalk the herd, and anybody who's hanging around the edges is a target, number one. So they're not targeting the biggest and healthiest, and they're not targeting the species that actually has, you know, fangs and claws and horns that they can fight back with, right? You want to go after the sickly gazelle or the old limping zebra that that can't hardly keep up. Which kind of makes me wonder why Chanos did challenge strategy. And I think maybe he's just, that must be like an ego or hubris or something, where maybe he takes satisfaction in like playing with the big dogs or something. It seems like he would have been able to pick any other company and short them much easier, right? Throwing a bunch of money around, he could probably pin another company's price down, whereas strategy is just so highly traded. I think he's either made a pretty big mistake, or maybe because strategy is in the news, he's just latching onto that trade for publicity. Maybe there are other hidden advantages that I'm not aware of. I don't play in the same areas that these people play in, so there could be a whole host of reasons why he's kind of taken on the biggest, most deadly company out there. But I think it is definitely a warning for investors that are quick to jump to the quickest, the fastest horse. And if they are not prepared to defend themselves with these preferred instruments, and they just came out with like, what is a $4 billion worth that they can come out and start raising with STRD. Like, strategy weathered the last bear market without those instruments. And so now strategy's like, strategy's not a young gazelle anymore. Like, they're a rhinoceros. They've got some size, they've got horns, and so they've got weapons. You're not when the hyenas start circling, there's going to be hundreds of easy prey out there. Companies that have over leveraged, they don't have the preferreds. Maybe they have encumbered Bitcoin. I don't want to call it a red flag. Like, when we talk about cryptocurrencies and shitcoins, for me, the red flags are, pretty obvious: pre-mined, centralized, proof of stake, and no fixed supply. And so I wouldn't really necessarily call having encumbered Bitcoin as a red flag in that sense, like, because shitcoins are basically scams, right? You're just waiting for the rug pull. But I think some of these Bitcoin treasury companies, they're not rug pulls necessarily, but they might mismanage the situation. And if they can't get favorable terms with loans or whatever without encumbering the Bitcoin and basically putting it at risk, some of these companies could get liquidated, right? They could be forced to sell their Bitcoin to make the investors whole or whatever. So that's definitely a risk that we have to be aware of. Metaplanet seems to be the next man up that's implementing the strategy the best. And I gotta imagine that Dylan's out there in the lab, like, figuring out how to get these preferreds out the door. And so maybe we'll have an MTPLFF and an MTPLFK and an MTPLFD at some point. I think that would be super bullish for them. But for me, for now, I probably will take a Metaplanet position at some point, kind of like a token position, just just as a almost like a tip of the cap to the effort that Dylan has made even before they blew up. Just being a good Bitcoin actor in the space, and so I'm happy for his success. But I'll probably take a small portion, and maybe I'll buy Metaplanet at the top. Who knows? Whatever, it'll be fine. But I want to be able to do it in the places that I already can do business, right? So when Metaplanet is tradable on Tasty Trade and Robinhood or whatever, that's probably when I'll take a position. And it won't be so large that even if I do buy the top and it comes down to 75% in the bear market, that it'll hurt my feelings at all. But a nice liquid options market would be nice too, so that I could sell covered calls on the way down and make that heartburn a little go over a little better, a little easier. So just be careful in them out there in them streets. It actually reminded me of, let me see if I think I pulled this up. Yeah, it reminded me of this game that my son played and got me hooked on it a little bit. I'm just gonna play it.
'Cause my only crime was hoping.
So it's called Agario, and you're like a tiny dot when you start the game, and you try to swallow the smaller dots, and then you try to swallow the other players as you get bigger. And this is kind of this is the way that I see it, right? So strategy right now is like one of these giant big blobs eating the smaller that will it's not strategy really that's eating the competition, but when the hedge funds come out and try to eat the smaller players, it's going to be a lot harder to swallow strategy, right? You've got to like run away from the big players and go after the little guys and make them your lunch. So just make sure that you are not in size with the sickly gazelle when this goes into a bear market. You want to the fastest horse is great, but the strongest horse is also a real thing. So that's kind of all I wanted to say about that. Let's grab comments and then we'll see if there's any trades. I actually tried to trade when the market was closed on Thursday, so that was fun. What's up, William? Do you have any information on the moving liquidation preference that was in the latest 8K that Dan just mentioned? No. I saw him share that, and I started to read through it, and then my eyes kind of glazed over. So the moving liquidation preference, it's still backstopped at 100, so it can't be. It seems like they've made it better for investors, which kind of seemed unnecessary because it was already good. So it seems like they can get an even more favorable liquidation price based on if the price is going up. Whereas before it was just backstopped at 100. So now it's like it's backstopped at an even more favorable price, but 100 at its worst case scenario. Maybe just trying to stoke interest in that fund so that it gets bid up so they can hammer the ATM harder. That's kind of like my very first guess. I'll have to take a look at. Dan's been discussing it in the chat as well, but I didn't know he had posted about it. I'll have to take a look at that and see what his analysis said. Keith says basically makes it that if stock is trading higher, then the liquidation pref is higher. Still can be below 100, better for holders. Yeah, that's what I was trying to say as well. It just seems like it's a better deal for the holders, which should make the risk less, making it making it trade higher. It should be able to trade higher. Its theoretical ceiling should be a bit higher now. So bullish for the price of strike, I would think. All right, let's check out the accounts since I wasn't able to do what I thought I was going to be able to do on Thursday. Some people have been asking me how I decide when to roll. I got a DM specifically was asking about Hermes Lux, who he sells the 10 deltas and generally between 30 and 40 days, and then rolls them maybe every week, 2 weeks at the most. And that makes sense for if you have one that's open for 30 days, because there's less days to expiration, so the value should decay a little bit faster. I'm opening mine up at around 45 days, so holding mine for 2 to 3 weeks is pretty routine. I can't really say that one is more favorable to the other. I'm trusting Tasty Trades research, which says that for out of the money options, 45 days is the optimal theta increase in acceleration. And that acceleration does continue for more than the 2 to 3 weeks that I hold them. However, once you get under 20 days to expiration, your gamma risk starts to increase. So you could have a 30 to 45 days expiration option and you could hold it all the way till expiration. But when you do that, you increase your gamma exposure significantly. So for as far as, if you're running the Tasty Trade playbook, they're basically saying at 45 days and for 2 to 3 weeks, there's a sweet spot where theta acceleration is maximized and you get out of that trade right before the gamma risk becomes too much of a threat, really. And that seems to work fairly well for me. And with the way that he's doing it at, closer to 30 days, going 1 to 2 weeks totally makes sense for that, because you're going to want to roll it when there's not enough premium left to make holding it worthwhile. I think that's the bottom line. And so for the 45 days ones that I'm selling, that's generally going to be between 2 to 3 weeks. And the 30 to 40 days to expiration that he's selling, it's probably going to happen between 1 and 2 weeks. So to me, that just makes sense. And so just for example, like looking at these, I had actually rolled these way out to 52 days to expiration. 56 days to expiration? Yeah, I think so. 55, something like that. And the reason I was willing to do that in this case is because I had used some margin, so I wanted to chip away at the margin usage as quickly as possible. So by going out a little bit farther, I was able to get a little bit additional premium, but also because Strategy's earnings is August 7th. And I thought, okay, if I pick the 15th, then somewhere before the 7th, most of the value of extrinsic value will have decayed out of this option by then. And then I can, even if I hold this right till August 7th and just leave like a week left in here, I'll be able to capture most of this premium over that time. The exception to that rule is when the price of the underlying goes up. So if I sold this for 14 and I want to buy it back when it's under 50% of this, right? I want to buy it back when it's 7 or under, and then roll it back out for 14 again and just rinse and repeat. Well, when the price of the underlying goes up, and I almost said when the price goes against you, but it's going against your short strike, but it's still going for you as a long holder of the underlying, right? Like I want the price to go up. I want the price to go up to 430. I want the price to go up to 450. I want the price to go to 650. Because the rest of my long positions will continue to appreciate. I don't have 100% of my position covered. If I did and I was just hunting premium, then yeah, I wouldn't care about the price going above 430. But I think I got a little off track there. So if I'm selling this for 14 and I'm going to roll it when it gets to 7, well, it's not going towards 7. It's actually going in the opposite direction. So it makes sense that I might end up holding this position for even longer, right? I've already had it open for 17 days, and it's got more extrinsic value in it now than it did when I sold it in the first place. So I will probably have to hold this for another 2 to 3 weeks at least, just to get it down below 14, closer to 7. And even in that case, like if this was worth 7 and it's like August 1st or July 25th, then I kind of have to be a little bit choosy about, do I even want to roll it and then have to deal with taking it back off on August 7th. I don't want to hold any, if possible, covered calls over earnings. I'm not necessarily predicting that the price moons, right? Because we had a giant earnings miss last quarter and the price of the stock didn't tank. So it's not necessarily that we have this huge EPS and strategy is going to go to the moon overnight, but I'm also not taking a chance that it does, right? If the algorithms, if the market is surprised by this, I don't want to be caught short during that earnings call. Maybe it's all baked into the price and strategy's price does nothing over earnings. But if I don't collect theta for one day, right? Where's my net theta on these? Yeah. So for 17 covered calls, if I take these off and I don't collect theta just on that earnings call, it's only going to cost me $641. Like, that's not a big deal. And if I have to do that 4 times a year during the bull market just to make sure that what if they come up with some kind of, what if they've already done with the 84 or with the 42 plan, and now maybe they're going to have an 84 plan or a freaking 168 plan, or they could have some kind of amazing announcement. Maybe they'll do maybe they're going to come out with a new preferred for variable interest rate that's pegged to the Fed rate or something. And maybe the market flips out over it. I'm going to have as few covered call positions over earnings on August 7th as possible. So just to run down the roll strategy here. If I sold this for 14, then regardless if it takes 1 day or 3 weeks, as soon as this is worth like 700 or less, I'm going to start looking to see, is this ready to roll? If the price of strategy goes down fast, then I might be rolling 24 hours later, 5 days later. If strategy's price is going up like it has been, then I may just sit on my hands because I don't want to pay more to roll it than I sold it for. So while I try to stick to the 45 days to expiration, roll it every 2 to 3 weeks, that's going to change based on what strategy's price is doing. There's going to be a little bit of a reaction. I'm reacting to strategy's price, which is going to affect how quickly the option that I sold decays. If it decays faster, I'll roll early. If it decays slower, I'll roll later. That's the TLDR version, I think. What's up, Taylor? Let's see. I don't know. Josh was talking about some crazy scenarios where everyone is piling into Strife because of the liquidation preference. So maybe adding that to Strike is trying to prevent cascading risk in an extreme scenario. I need more time to wrap my head around it. Crazy scenarios where everyone is piling into STRF because of the liquidation preference. Okay, yeah, I'm gonna have to figure that out as well. What's up, Forrester? Reliably grinding with smart work. We love to see it. Good to see you, man. Do your vids show how to do this like a man and save the management fee and be less mechanical to max yield? So in my pinned tweet, I've got my essential videos. You don't have to like watch 433 of these damn things listening to me go on fucking tangents. Let me see here. I need to start adding to this, and BTC Pikachu actually asked for a bid-ask spread video, so I'll probably do one on liquidity. I don't think I have one on liquidity. Yeah. But I started to try to make this kind of like an all-inclusive. I mean, these ones at the top are like, you know, how to do a cash secured put. This is like, I don't know, 30-second video or something. Those are kind of dumb. But, you know, I've got my main covered call strategy here. You could, you know, if you prefer watching on YouTube, I need to put together a playlist that has all the same things, but I don't have that up yet. That's a good reminder for me to do that. Videos are still a lot easier to watch on YouTube than they are on X, unfortunately. The wheel is kind of like the basic strategy that I started with and still utilize to this day. And then if you want to get into more, you know, I got Greeks, spreads, you know, leaps, poor man's covered calls, how I kind of view buying calls. I got to double check this one. I meant to update it once I saw Grain's gamma curve stuff. And when I first did this video, I was like, okay, I get buying out of the money options because you can get delta for cheap. And I get buying in the money options because I can sell covered calls against them, poor man's covered calls. But I was like, why buy the at the money or the slightly out of the money ones? And the reason is because you can kind of hit the sweet spot in the gamma curve between 10 to 20% out of the money all the way up to 10 to 20% in the money. So actually I need to rewatch this video myself and see if I updated it to include that or not. I think maybe I did. And then I've got one on option management, like, how to decide when to roll, things like that. And so every time I add something that I think is kind of essential or something that I haven't covered, I'll add it to this list. Articles kind of sucks because nobody reads them. But they're kind of cool because they're editable. So this is the only way that I have figured out to be able to continually edit without deleting a tweet and reposting it. And so this table of contents will continue to grow as I add essential videos to it. But yeah, so I don't know, was that a dozen videos out of 400? I think this is probably the way to go rather than try to just watch all 400 videos, which I would appreciate if anybody was out of their fucking mind and wanted to do that. You're more than welcome to. But yeah, I would just go right to the good stuff. Maybe I need a trade like a man. You know what? I'm gonna bookmark that. That's gonna be the title of. Maybe I'll kind of like reset the room and I'll go over the strategy from scratch and I'll just call it like the trade like a man strategy. And actually, that's probably a good segue. So thanks for asking. The covered call ETFs are finally profitable. So I started this IRA on January 23rd with $215,990 in it. And I plowed it all into Misty. And then at some point when IMST came along, I was like, all right, let me split this account into half. So I put half in IMST, half in MSTY. And this IRA is finally profitable, right? It's worth about 221 up from 215. So they're up about $6,000, which is, I'm sorry, 221. Yeah. Or was it 224? Yeah, I think it was actually closer to 224 now. So they're finally turning a profit here, which is good to see. My account is at 241, so about 16, 17 grand more than the 224. What's the percentage on that? So 241 minus 215,990 divided by 215. Okay, so I'm up about 11% since January. So that's pretty cool. And it doesn't necessarily mean that I out traded them. Like I would have to go through and I'm not going to do it, but I would have to go through and download all of their trades for the past 6 months and calculate how much premium they generated based on their assets under management. And then I would have to go to my account and download my big ass spreadsheet, which I will probably do this part. I'm gonna do a analysis and big deep dive on mine. And I would have to calculate how much premium was collected on my 200 grand and see who actually collected the most premium. But that is not always necessarily going to translate into share price because someone could ignore who traded better, right? Even if you're deciding between IMST and MSTY, someone could decide that they want to trade one of these instruments over the other because they're paying higher dividends. And so that's going to pump up the share price of that stock. So, Jeff could outtrade Jay, but if market sentiment wants, bids up Misty's price, then Misty looks like it's winning. And the same could be in reverse, right? MSTY could be generating the most premiums or the best trades. But if market sentiment bids up IMST's price, then it's going to look like IMST is the better instrument. But it's still fun, right? It's still fun to do. I'm a gamer. I like PvP. So I kind of like setting this up as a competition. And, but yeah, I don't want to say that my lead is insurmountable at this point, but I think I would have to fumble pretty badly in order to let them catch up. And long story short, it's not really that hard, right? Like you just sell the covered call 45 days out. Pick an out of the money strike. It can be anywhere from like the 10 to the 30 delta. And then every 2 to 4 weeks, roll it at a reasonable time frame. I sold this for 12 when it's worth 6. Okay, time to roll it. Doesn't have to be exact, right? I mean, it could be between 5 and 7. The hardest thing to do or to not do is to panic roll, right? So I sold this for 12, and instead of it going down, it's going up. This is when you have to be disciplined and just do nothing. Just wait. There's the premium that I can collect here is actually getting juicier. So this is a better call to sell than it was when I sold it the first time. So I'm not going to buy it back to roll it out. Like if I would sell this call today, then I'm not going to buy it back so that I can sell a different one. I'm just going to sit on my hands and wait. And if I have to wait until, August 7th when earnings is, I'll probably have to deal with it at that point. But in this account, I'm not going to take off all my covered calls. I'm going to at least keep on enough to keep the net theta positive so that there's money draining into this account at all times. I think that's only fair to hold myself to that rule. And then I think what might even be more important than the days to expiration and the strike selection is what you do with the premium that you collected. So if the price of strategy, if you think it's going up, then collecting that premium and buying long calls should print the most money. To a lesser extent, taking that premium and buying shares would also be accretive. But when I started this challenge in January 23rd, strategy wasn't going up. Strategy was going down. And so all of the long calls that I bought with the premium basically all evaporated because I bought June and July 1080s that all went to hell. If I had been buying shares that whole time, then I would have even more shares than when I started with. And so if you're collecting this premium and then you're doing something dumb with it or something that's capital destructive, like buying short-term calls with it, that's not going to work out well for you. But at the same time, at least I paid for those calls. At least I paid for those lottery tickets with premium that I generated, right? I didn't just go out and earn money at my W-2 job and then light those on fire. Like I bought those lottery tickets with premium that I generated on my portfolio, from my portfolio. So yeah, did 90% of my Junes and Julys did I lose that value? Yes. But it was value that I kind of created out of thin air by selling the calls in the first place. So the what I did with those premiums was bad, but it was kind of like the second least bad thing that I could that I could do with them. Um, and I didn't just take those short-term losses and make a long-term philosophy change, right? I've been doing this since May of 2020. And so I think over time, this just works out in the end. If I ran this particular play for 5 or 10 years and, the number wasn't going up and to the right, then that would be a problem. And I'd have to hopefully figure it out before 10 years of losses. But, or, if you think that the price of the stock is going down, then maybe selling premiums and buying something that's uncorrelated with Bitcoin that isn't going to go down over that time frame. The next time that Bitcoin legs up to 150, 200, whatever, if Tesla's hasn't mooned yet, I will be rotating the profits into something like a Tesla. Tesla's price should be uncorrelated enough with strategy. I mean, it's still a tech stock, so whatever happens with the Fed rate is going to affect growth stocks, tech stocks similarly. But, Tesla's got a whole lot of other variables, right? They got their EV car sales, they've got Cybercab, they've got Optimus, they've got batteries, they've got energy, they got all kinds of happy horse shit that should be uncorrelated with Bitcoin strategy, etc. So if you think that the price of strategy is going up and you're selling premium, then it makes sense to take all of that premium, as much as you can stand, and plow it back into more shares or long calls. If the price of strategy is going to trade sideways or down, maybe you find something else to put this premium into, or just live off of it if you're retired. That's kind of the whole point of the exercise. See, if Q1 and Q2 are replicated, even with a 20% drop in the underlying, come December 30th, I come out ahead. Free money glitch. Even with a 20% drop in the underlying, come December 30th, I come out ahead. Free money glitch. Because of the premiums that you've collected? Is that what you're saying? Oh, because you took out the margin loan, right? So you took out the margin loan, 25K on Misty, YMAX, ULTY. I forget what that is. Ulti, Tesla, and NVIDIA. So I trade with my dad and my son. My dad's funny. He's finally kind of gotten like the muscle memory and the mechanics down. And so he had a little bit extra money that he put in there, some buying power, and like a week or two went by and we kept forgetting to invest it. And he's like, I was like, just sell some cash secured puts and something, you'll be fine. And he's like, all right, cool. I used up all my buying power. I sold a few cash secured puts, and then I bought 2 shares of NVIDIA. And I'm like, why? And he's like, I don't know. I just wanted to. I was like, okay, whatever, dude. So I still haven't been able to convince him that the whole point of the strategy is selling the covered call or selling the cash secured put to improve your cost basis. Every time you improve your cost basis, yes, you limit your upside, but you are increasing your chances of success. And for new investors, rookie investors, increasing your chances of success is going to be the main way, in my opinion, to not get wrecked. There was some kind of statistic about Robinhood that said like within 60 to 90 days of most Robinhood investors opening an account, they're completely broke because they FOMO, they panic sell, they FOMO, they panic sell, rinse and repeat, buy short dated options until they have no fucking money. And so if you can increase your chances of success, like just not going broke in 3 months is a win on Robinhood. So I know it's setting the bar kind of low. But the point is, selling the covered calls and the cash secured puts, you can aggregate small wins over time. That's kind of how I was explaining it to a couple of guys in the sauna the other day. Is they're buying some of these options like no bullshit that I'm selling them. 30 to 45 days out, and every once in a while they'd hit and be like, oh wow, I made 20 grand or whatever. But then it would be like 4, 5, 6 weeks in a row of losses. And they were trying to hit home runs, and I'm happy to just hit a single every week, single every week, single every week. And at the end of the year, my batting average looks pretty good. If you are an advanced trader and you're looking at the market and you're like, I'm about to hit a fucking home run, and you just see the pitch and you can swing for it. But if you don't literally know that's going to happen, like with supreme confidence, you can't do that shit. Not financial advice, but I think people try to put too much rational thought into the market, like, oh, well, if it went down, it must come back up, or if it went up, it must go back down. I just feel like it's going to go up, or I feel like it's going to go down. And I think that's kind of stuff is a recipe for disaster. I generally believe that over a long enough time frame, of course, its number go up, because I believe Bitcoin is going up forever, Laura. And so any Bitcoin treasury company that doesn't go out of business should be going up forever as well. But it doesn't mean it's going to go up by the expiration date on your call that you bought. So keep that in mind. What's up, Kanal? Stoked for the trade like a man. Start from the beginning video. Yeah, I think I'm going to have to do that. William, my mother panic sold Bitcoin for NVIDIA. Oh my God, when the July 4th wallet transfers news came out, at least she kept the strategy. Wow. Yeah, I mean, she's still doing better than my mother. I found out that she panic sold after the COVID crash and has been in cash ever since. And I just about had a fucking heart attack. I've been chipping away at her, but I can't get her to even. I can't get her to even get into like Strife for a nice little dividend. So retirement's just sitting in cash during the entire recovery, the V-shaped recovery. There's a lot of fear in people who have lived certain lives that that's pretty hard to overcome. So all right, back to the trades. So this is not ready to roll. Even though it's been open for 17 days, it's worth more than I sold it. I'm going to do nothing. If I have to do nothing until August 7th, that's fine. The long calls are still not profitable. Gonna need to see a leg up to 550 probably. Actually, these would probably be profitable much earlier. Maybe 450. 500. When that happens, that's going to open up the ability to, like when this gets to 550, it'll be pretty easy to sell covered calls against these, or else just take profits, period. So yeah, whole lot of nothing to do here. All right, my spending account. I've still Tesla took a dump. So this is interesting development. If the market gods are looking favorably upon me, strategy will moon while Tesla is still crap in the bed. What's going on with Tesla? Interesting. Yeah, I kind of feel like every dip for Tesla is a buy for the next decade, as long as your hold time frame is long enough. But yeah, just give me a nice strategy moon to 1,000 and keep Tesla at 300, and I will absolutely back the truck the fuck up and pile into Tesla. Probably leaps, some shares leaps, whatever, anything long. I should temper that a little bit. It like leaps are nice, but it is leverage. It shouldn't be. They shouldn't be treated casually. Like this is kind of like discretionary spending here, which I think I added some money. Yeah, I've got. Thought I deposited some cash in this account. Yeah, but in my main account, I would say I have half the portfolio in shares, the other half in long calls, and that's way too risky. I think 10% in leaps is probably pretty reasonable, but I kind of can't help myself being this bullish in strategy during this Bitcoin bull market that I've allowed myself to go a little bit irresponsibly long, as we like to say. But I think in just the standard portfolio condition, I don't know, 10% leaps, 90% shares is probably much more reasonable for someone who doesn't, just live in the, just doesn't bathe in volatility like a complete degenerate. But yeah, and so in this account, I have no shares whatsoever. It's just leaps, right? Because this is just my fun money. And so I don't mind taking a bunch of risk with this particular account. But you can see I have these two put credit spreads that I sold in Tesla, and it was doing bad and then it was doing better, and now it's like bad again, right? So if Tesla finishes at its current price, I will lose the majority of the value here, which would be the $1,000, which is the width here. This is the $10 wide times 100 is 1,000. So there's $1,000 at risk, but I collected $258. So $1,000 minus 258 was at 742. So the max loss on each of these is 742. But I've got 39 days for Tesla to do something good. And as long as we finish over 300 a share, I would at least be able to keep the 258 that I sold it for. But again, the roll strategy is the same. So I sold it for 258, and I am attempting to roll it when the price is half of that, 129. Clearly at a price of 550, I'm nowhere near that. And this has been on for 14 days. I think I put this trade on, I don't know, 2 or 3 times in a row with good success, and was able to roll it. And this is finally kind of going against me here, which is to be expected because I think the delta on these was I don't know, around 0.25, 0.3, something along those lines, which makes sense. I should get wrecked on this trade like once out of every 3 to 4 attempts, meaning I should not just be able to like have a fun, easy, happy-go-lucky time rolling it. So yeah, again, I will just do nothing, and if it takes me longer to roll this, then that's fine. I'll just wait for Tesla's price to rebound, or else if we're still hovering around the 290, like very close to expiration with like less than 7 days, like I might be able to roll this out for a credit at that point. So basically just sitting on my hands and doing nothing here. Yeah, and this is same situation as the other account. These are not ready to roll. 39 days to expiration left. They've been open for 17, but they're worth more than I sold them for, so I'm not ready to roll. All right, this is the challenge account. Same situation, nothing to do but sit here and wait. And hopefully I'll have better luck with the December 1080s than I did with the Junes and Julys. Currently they're still break even. I've had them open for 45 days, which means they have decayed over that 45 days, but Strategy's price has gone up, so it's kind of made up for it. So basically, I just need something magical to happen in the next 75 days so that I can take some profits on these damn things. And then, of course, 2 poor men's covered calls, which, let's see, this has been open for 20 days. There's 25 days left. Again, this would be like, I would be, as far as days to expiration, I would be looking to roll this. But since it's worth more than I sold it for, there's plenty of premium left to collect. If I don't roll this now, I will be exposing myself to more gamma risk. So let's see if I do roll this. Let's roll expirations to 46 days to expiration. I wouldn't want to roll to the 425 because that's like kind of risky at this point. But rolling to the expected move of 465 would cost me a debit. The only way that I could roll it for a small credit would be right about here, the 450 or 455. So I could do this. I would be kicking the can down the road. I'd be collecting a tiny, tiny credit here. But then I would just have to turn around and take these off. On the 7th. But maybe this works. Maybe this makes the most sense. If I had to roll these for a debit, I absolutely would not do it. Gives me a little bit of buying power to play with. $6.85. That is like, that's exactly what I need to buy one more December 1080. So why the hell not? Whoa. Not December 2026. December 2025. Ooh, the mid price. Am I going to be able to get it? This is going to be funny. All right, so let's see if I can get it for 680. I literally have 685, right? See what happens. Oh my god, I'm using $1 of margin. Oh my god, that's pathetic. I'm not gonna let myself get away with that. Oh god. That's fine. All right. Got to be careful stacking too many of these though, because in this account, this is supposed to be cash flow generating account. So net theta has to remain positive in order for me to be consistent with that philosophy. So by adding more and more of these long calls, it's going to kind of prevent me from closing some of these on August 7th. So maybe I shouldn't have done that in the first place. Yeah, actually, using $1 of margin doesn't make sense. I'm gonna take that trade back off. Whoa, not. So I'll lose about $10 on that. It's fine. I've lost more. All right, so instead I'll take that 667 and I'll just buy one share of stock. That's probably the smartest thing to do anyway. There's no theta decay on shares. So now I'm not using any margin. I have not increased my net theta drag on this account. That was probably the better thing to do. All right, the 5K account. Let's see, buying power. Yeah, there's no buying power to speak of here. So I'm just going to quick check. So I sold a $12 CLSK put. CLSK must be shit in the bed or something. Back down to 11.26. Okay. So at current prices, I'll be assigned 100 shares of this, probably 100 shares of Riot. These 718 puts are the ones that I'm copy trading with my brother-in-law. There's not much left here, so these need to be rolled. This ill-advised GameStop trade, I'll be happy to get out of, but let's see, I sold this one for $1. Not really ready to roll yet, still worth 66, that's fine. And then the long call that I'm selling the poor man's covered call against is only out till October. So I am going to have to roll this out maybe to January. It's going to be much more expensive, so I may have some rearranging to do to make this affordable in this smaller account. If I have to, I'll just dump these 100 shares of GameStop at a loss. That'll be more than fine. Probably be my penance for selling the cash secured put in it in the first place. Yeah, so a whole lot of nothing to do there. We'll check chats and call it a day. What's up, Howard? Leighton, I know this isn't your biggest interest, but do you understand this moving liquidation preference on the preferreds? So someone asked that earlier, and it just seems like it's a better deal for the investors because it sounds like you're getting the better of two prices. If the price is higher, you get the better price, and worst case scenario, you still get the 100. Like worst case scenario, you still get the par value. So it seems like they're making it more attractive, which should technically make the theoretical trade price of Strike higher. I thought it was pretty popular and they didn't need to make it more attractive, but that's just my first glance. All right, a whole lot of talking, very little trading, just a couple of tweaks, a little bit of maintenance. But that's really how this should go. Covered call selling should be very low. You know, it's not just set it and forget it investing, but it's also not like high frequency day trading, right? Come in, check your account once a week, once every couple of weeks, should be fine. So appreciate everybody tuning in. Be good, y'all.